Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my dear partner, Hari. This is episode 38. We are continuing on our conversation about Canada Goose. In this episode, we are talking about the financial health of the company, the management, and ultimately the valuation. Is this company cheap or expensive relative to its intrinsic value? We'll talk about these in this episode. In the previous episode, if you haven't checked it out, please go check it out. We talk about Canada Goose, their business, their competitive advantage, their moat, etc. So check that out. Episode 37. Okay. Again, disclaimer. We want to give you the disclaimer here. You know, we're not trying to say that this is a buy or this is a sell. What we're trying to do with this podcast and this platform that we have here is to go through this exercise of analyzing companies with you, and so that we get better at analyzing companies, but also you understand that these are the types of process that we go through. So ultimately, this is really an educational entertainment platform. We're not trying to give you financial advice here.
And what I would say is that this decision-making process is basically what every value investor does in some form or fashion. They may have different checklists or different things, but ultimately you're trying to look at the business from a top-down and bottom-up kind of view, which is what we do. So when you build that framework out, you'll be successful at following the same procedure, because I can't emphasize that enough. If you don't follow the same process every time, then you skip steps. That's where you start making mistakes. Mm-hmm. That doesn't mean that with a checklist you won't make a mistake, but it really is important that you at least have a framework and an investment thesis when you go in, because when times get tough, you can always look back to that investment thesis.
Yeah. And again, we're going through a checklist, value investor checklist that we've created. So if you don't have it with you, please go ahead and email us at info@valueinvestor.org. We'd be happy to share our checklist with you. Okay, let's just dive right into this. Yeah. So we left off in the last episode at the relationships, and one of the questions that we didn't answer is return on equity, return on capital employed. Yep. So can they sustain growth without putting much into the business, and what does the return on equity look like in that aspect? So if you look at the return on equity number from 2016 to 2018, they've been significantly improved. Yeah. So for example, in 2016, they were at 18% return on equity. 2017, it was 14. It kind of went down. In 2018, it just shot up to 39. So that kind of speaks to, I think, the underlying reason why this is happening is because they're like we said in the previous episode, they're really switching their channel mix to direct to consumer, which is higher margin, which leads to better return on equity.
Right, and we've talked about this throughout the podcast. We don't care about revenue. We care about how much money you keep. It's not how much you make, it's how much you keep, right? So this number, the return on equity, directly ties into how much you keep part of it, right? So the management understood that with the direct-to-consumer model, they would be more profitable for every dollar of sales, and that's why you're seeing these numbers go up. Mm-hmm. As they move to a direct-to-consumer, they're making more money off of every dollar that they invest in the business. Yeah. As an investor, that's how you should be thinking too. Yeah. So I don't think they would shut down the wholesale market completely, but I think they're going to be... Their heavy emphasis will always be on this direct-to-consumer going forward.
Yeah,
so.
Exactly. I wonder, moving forward and just kind of conjecturing, 2019, 2020 number with direct-consumer, with ever-growing direct-consumer proportion of the revenue, 2019, 2018 number, it might be more impressive than, 39%.
Yeah, I would say that if anytime you have a company that says their return on equity is above 30%, and assuming that they don't have a whole lot of financial leverage, which they don't, you should take a look, right? Mm-hmm. I mean, that should be a something to focus on when you hear that number. Mm-hmm. So I would highly recommend, paying attention to this number because it really matters. Right?
Yeah. So let's talk about, I think that's a nice segue into the financial health. Do they have enough cash? So in September 2018, this is the last report that they came out with, the quarterly report. If you look at their balance sheet, they have cash, just straight up cash, $32 million. Total current asset, $406 million. Again, this has inventory in there, so keep that in mind. And current liability, total current liability, $103 million. So when you compare cash and total liability, it's not overwhelming,
Yeah.
Yeah. And also, another thing that we need to point out is, they're generating enough cash from the operation to finance growth activities. And so they don't really have to tap into, debt to grow, because they're generating enough cash to put it back into the business. So, and also, if in case they are in cash crunch, they have remaining revolving facility. They've been tapping into revolving facility for some time, but the remaining revolving facility of about $100, $97 million, $100 million, I should say, $97 million. It is available for that use. So, in terms of financial health, I think they're in good condition.
Right.
Anything to add there?
Yeah, I no red flags here. So This to me is not they don't have a giant cash balance that really affects their valuation, but they don't have a lot of debt either, and seemingly are generating enough cash. What'll be interesting is how, are they going to consume all of that, as they move into China and as they expand operations in East Asia and the rest of the world? How much will that consume? Because I don't think, Skechers will open up hundreds of stores in a country. These guys won't do that. They'll open up maybe 3 or 4
exactly
in a place like China. So how much money will it cost them to start, and how much will be ongoing, kind of expenses? So
in terms of financial health, I think we are in agreement that they are in good condition financially. So moving on to the next bullet point, which is management, which I think is quite interesting. Let's first talk about the share structure, and then we can go into this Bain topic here. So the share structure, they have dual share structure. It's kind of similar to Skechers.
Right.
So dual class structure. One is called multiple voting share. So for one share, they have 10 voting rights.
Right.
And the other kind of share is called subordinate voting share, which is just one vote per share.
And that's what the subordinate one is, what trades on the stock market.
Yeah. So this is the common share. And what's interesting about this company is that Bain Capital, which is private equity / venture capital arm of Bain, kind of Bain brand. They have Bain and Company, which is the consulting arm. Bain and Capital, which is the private equity / venture capital arm. So Bain and CEO, the CEO of Grey Goose, they own collectively 95% of the voting rights. And so if you break that down in more detail, in total, Bain Capital has 64% of voting rights. So they can really effectively do what the hell they want with the company. And CEO has 31% of the voting right. So when we talk about, majority, Bain Capital has majority, so it can kind of sway the votes left and right.
Bain Capital is effectively owns the company, right? Because they have control over the business. Mm-hmm. So in essence, you are a subordinate to Bain Capital.
Yeah.
So, and which is different from what we had talked about last week with Skechers, in that the CEO controlled the company in Skechers.
Yep.
In this instance, a third party actually controls it. And so where this is a problem to me is that when the CEO doesn't own the company, the third party management company may have different incentives to to push growth at any cost, because it raises the share price and that kind of stuff. And it's not necessarily that they would do that. And because they have a controlling interest, they want to also maintain a longer term approach. But a lot of private equity firms function differently than their job is to essentially return money back to their limited partners, right? And so they will try and pump up the price and then sell, right? And so this was what people colloquially called the vulture capital model, which is essentially you buy up a company, sell off the assets. They're clearly not doing that here, and I don't see, they don't always do that. And for the most part, these kind of companies offer some value, but they typically leverage up and buy these companies in, and this is what they did with Toys R Us. And you saw Toys R Us fall apart, which was a very profitable business that they put in way too much debt. Toys R Us hit some rough patches, and then it was over. Whereas if they were just limping along, they or running as a business without that kind of influence, it would be fine. So this is a different story because they are growing like crazy. And so what you saw here is when Bain took over, they've pushed this growth story very, very heavily. And if you look at their financials, that's when they started going nuts with sales, and wholesale went to direct to consumer. So this to me is not a hard pass kind of red flag, but it's certainly a yellow flag kind of thing that I would be very cautious about. Third-party companies kind of can do, since they have voting control, they can do whatever they want. With the CEO running the business, or if it was the founder who owned, voting control, I'd be less inclined to see them try and do that because, one, it's a personal thing that they own this. They want to see that succeed. It's their personal image. Bain has hundreds of other investments, and they will happily sacrifice one if it means more money for another, right? So I don't know that's, you can look at the incentives cleanly in this scenario because they have incentives that are that are hidden.
It's clouded.
That are hidden from you.
Yeah.
So
it's interesting. If you look at the Bain management, if you look at the 10K, they talk about this quite extensively. The management agreement is another thing that was interesting. When they bought the company when they bought Canada Goose in 2013, they went into the Canada Goose and Bain Capital went into this agreement. It's called management agreement. What it was is Canada Goose was to pay quarterly fee equal to 0.4%, so 0.4% of total revenue generated during the calendar quarter to Bain and Company managed. So this is a management arm of Bain. Like we said earlier, Bain Capital and Bain and Company, two different companies, but under still same Bain brand. So which is kind of interesting. You buy the company and you give all the consulting fees to your cousin next door. This is what's happening here.
Now to be fair, this is not illegal.
Yeah.
Bain could literally walk in and say, all of the cash on your balance sheet, you give it to me, right? I mean, they own the business, so they have the ability to do whatever they want with the cash, right? Because it's their cash. But still, I mean, what's stopping them from raising that fee to whatever they want? Or now, obviously, they have an incentive to see Canada Goose grow because they'll make more money if it grows. Yeah. So I'm not. Please don't take this as never touch any of these kind of companies. You just have to be more mindful of what is their incentive. Yeah.
And again, kind of going back to the management agreement here, giving the business to your cousin. In 2017, with the IPO, they terminated the agreement. So it's interesting. So they said, okay, we'll give your cousin $9.6 million lump sum, and then let's just terminate the contract. Let's just terminate this giving money to the cousin thing. Yeah. And so with the IPO, they canceled the agreement with that amount. So no longer have to pay that going forward, which I think is good because the revenue is going up. The 0.4% of the revenue might be quite a lot going forward. So okay, in terms of dividend and share buyback, in terms of shareholder-friendly way of managing capital, the shrewd way of managing capital, they're not giving out dividend because they're growing so fast, and they're not buying back shares.
Yeah, and unfortunately, they're also selling shares on the open market, right? Yeah. So if you think about it from the perspective of the company, for most of their history has been overvalued. Mm-hmm. When they IPO'd, people thought it was the next thing, next hottest thing since, Louis Vuitton or something like that. Mm-hmm. And so they've carried a price premium,
Yep.
which is not necessarily unwarranted given their high return on equity and things like that.
Yep.
But they've actually sold shares on the open market. And funnily enough, the underwriter actually lost $60 million on the underwriting Canada Goose secondary offering.
Oh, really?
In 2018.
Because they did it twice.
Yeah, it was late 2018. So they've lost like a ton of money because there wasn't as not much interest because the price was so high. And at the end of 2018, things kind of collapsed.
Oh, yeah, that's right.
So they weren't able to sell it for what they thought they could. But if you're selling shares when it's expensive, it's okay because you're selling an overvalued asset for money to then take that money and grow your business. But I would be careful about that because if you're truly generating the amount of money that you need via cash flow, I want to see that being used to grow, not selling my equity.
Yeah.
You've diluted me when you sell that. They had 100 million shares. They have now 110 million shares. I mean, my equity is worth less.
Yeah,
now
that much less
because of that. So
yeah. So interesting. I mean, it's important to keep that in mind, and you're going to see the number of shares go up. If you look at the income statement, they'll show the total number of shares.
Yep.
Toward the bottom of the income statement. So make sure to look that up if you're interested in this company. And again, like we talked about, the Bain Capital owns the majority of the voting shares. So they have directors at the board of directors level. They have 2 people from Bain Capital on the board, which is
not unexpected.
Not unexpected. Yeah, exactly. And if you look at the, I thought this was really interesting. I want to get your take on this. If you look at the compensation package for the CEO, right? The target for the CEO for Canada Goose is centered around EBIT number. So if you hit this EBIT, your cash bonus or your stock bonus jumps to whatever.
Right.
So what do you think about EBIT as a measurement of performance?
It's the best measurement probably of performance because he can't control the tax rates. He can't control the CEO can't control the the other like interest rates that they're going to pay because they're already set. They're outside of his control. But what he can control is how much money they make, right? And so EBIT is probably the best number to look at. And so if I'm trying to set a compensation targets, I would set it at EBIT also.
Yeah, but I was thinking like you could do EBIT, but also you could load it up with debt and get a great EBIT.
Well, so
you could. I was thinking you would do EBIT and kind of couple it with ROE number or ROIC number or something like that.
Well, so the thing about EBIT, because it's before the interest and taxes, you aren't going to really have any impact on the debt, from the debt side.
Yeah.
Because what you're right in that you can kind of play with financials.
Yeah.
But what you can't really play with is the net income side of the things. So what would happen is if you were trying to manipulate these numbers, your revenue is your revenue. It can be manipulated. Don't get me wrong.
Yeah.
And then your cost of goods sold, so their gross margin is at 75%. So why they were pushing EBIT is that they're saying, we really want you to get the direct to consumer higher because it improves our operating margins, which is what EBIT is basically the operating margins.
Yeah.
So they're effectively saying that that's going to translate into higher things. So I think this is the correct metric. I'm not also opposed to having a return on equity
as
a target.
Yeah.
Now,
because
the only danger with the return on equity is then you can load up on debt.
Yeah.
And so you'd have to say return on equity with a debt to equity ratio or something like that.
Yeah. Yes, because that's one of the things that you talked about with Bain Capital coming in, these private vulture capital coming in and saying, just load up on debt, and then you have great EBIT, for example, or great, return on equity. Right. So to prevent that from happening, some measure of financial health would probably be beneficial. I thought. But again, something to keep in mind. Okay. Should we move on to the valuation?
Yeah, let's hit it. So Tell me what your assumptions are.
So the growth rate of, they've been growing at tremendous level, right?
Yeah.
The growth, compounding growth runway, compounding growth, annual growth rate is 42%, starting from 2016.
Yeah.
So I don't think that's going to be sustainable. It's not going to grow at this level for 10 years.
Right.
So I just gave it a modest 15% for 10 years, the whole way through.
Okay.
And then the discount rate of 10%.
All right.
And what we're doing at the end, we're subtracting out debt, or we were adding or subtracting, depending on your point of view, debt and cash balance.
Yeah.
And then it kind of gave us a range, right? This is never a precise science. Somewhere between 28 to kind of 35, range. Of share price per share.
Yeah, and so for reference, the shares are trading around $50 right now.
Yeah.
So we're talking about an intrinsic value of $30 to $35, which means a margin of safety of $15 to $17, $18 a share.
Yeah.
So we're pretty far off.
Yeah.
Valuation wise, and if we played with the numbers even a little bit, gave it a 25% growth rate, that number can get to $40 of intrinsic value, but the margin of safety price is never above 20, 22 without just being way too aggressive.
Yeah.
And so I picked a higher, so he and I don't actually discuss our valuation before the podcast. So we just kind of do it on our own, which is how you should do it also.
Yes.
And then we come and discuss that. And so I think even with a more aggressive, I said 25 for the first 5 years and like 13 for the next the next 5 years, so 6 to 10 years. But I'm still getting $35, $40 to $40 per share. And so what that really tells you is this is, I think we can, first of all, we can safely say that I think this company has a predictable business that we can understand, so that we can feel safe to put numbers behind this, right? I think the growth rates are going to be pretty good going forward. If it's 15% and it's 20%, you still win.
Yeah.
But you got to have the right price that you're paying for this, and that number is around $15. $15 to $20.
Yeah.
I would feel comfortable buying this. Anything above that is really stretching it. I mean, what you're essentially hoping for is eye-watering growth rates going forward, right?
Breakneck, yeah.
Because I mean, just to give you an idea, like if we use the current growth rate of 42%, right? We're talking about a intrinsic value of $76, right? And a margin of safety price of $38, right? So they'd have to grow and they're still expensive relative to our margin of safety.
Yeah, that's grow at this rate for 10 years.
Yeah, for 10 years.
Yeah.
So, I said 42 for the first 5 and 15 for the next 5.
Okay, yeah.
So it's still, and that's now they're entering China, which is good. I'm not saying that they can't hit these numbers, but they're not going to be growing at China at 42% for 10 years, right? And even China won't be enough to offset slowdown in like the U.S. and other places where once they've saturated that, right?
Yeah.
So I don't know if they can do it. Now, maybe they expand into different areas, into different parts of cold weather gear that allows them to have more peripheral sales and stuff like that. But all we're saying at this point is you can't just assume they're going to hit a 42% target, right? I think you can say that a 20% number is very high, is a lot more reachable.
It's reasonable at that level.
Is a conservative number. And so I would say from a valuation standpoint, it's just too expensive. There's no doubt about it. Now, at $20 a share, I would be very comfortable saying this is an interesting, investment. And I would have to then make the decision of what other investments do I have? What is my opportunity cost here, right? And that's why we can't tell you buy or sell for any business, because we don't know what your opportunity cost for other things that you have invested in, right? So, which is why we would say this may be an interesting company to put on a watch list, just like we did with Skechers.
Yeah.
But at this price, it's too expensive.
Yeah, it definitely belongs on my watch list.
Yeah.
I'll say that. Canada Goose, for 4-year history that we have available for us, they're growing. I mean, they're doing everything right.
Yeah.
I think.
Yeah.
They're doing everything right.
I think we can overlook some of the little flaws here and there.
Yeah.
I mean, I don't think the Bain Capital thing will sink them.
Yeah.
Unless things start to get tighter in terms of growth, I think, and at that point, your thesis is different, right? So, we are all making the assumption based off of is that there's going to be good, sustainable growth, and that there's a long runway ahead of them,
Mm-hmm.
right? I think that's the fundamentals that we can agree on.
Yeah.
But I think the growth rate has to be very aggressive right now to justify the current price.
Yeah, I agree with that. Okay. So that's it. That's it of this episode 38 of Canada Goose. Do you have any more comments you want to add here before we close out?
No. So I think we'd love to hear your feedback. This is number 2 company that we've talked about. Tell us what you think we're doing right. Tell us what you think we're doing wrong.
Yep.
Maybe suggest a company that you'd like us to talk about, or if you'd like to suggest modifications to our checklist. We're always, we're learning as we go through this, and tell us what you think we can improve upon.
Yep, absolutely. We're wide open. Send us any feedback, negative or positive, preferably both.
Yeah.
All right. Thank you guys for joining us on this episode 38. We'll see you on the next episode.
Thanks.